For most businesses, safety compliance feels like, well, a chore, right? A necessary expense you just have to deal with. But what if I told you that your safety program isn't a cost center at all? What if it's actually one of your biggest profit drivers? That's exactly what we're breaking down today, the deep financial link between OSHA and workers' comp and how you can flip the script and turn compliance into a powerful business advantage.
Just look at this number for a second. $97.4 billion. That is how much American employers pay out every single year in workers' compensation costs alone. It's a truly staggering figure that directly impacts the bottom line of businesses all across the country.
But here's the thing, as huge as that number is, it's really just the tip of the iceberg. It only covers the direct costs. The real financial pain isn't some one-time fine or a single big claim. No, it's a hidden, compounding cost that can quietly bleed a company's finances for years to come. So, to uncover that hidden cost, we've got to understand the two major players in this whole game, OSHA and the workers' compensation system. The best way to think about them is like two sides of the same coin. One is all about preventing accidents, and the other is about dealing with the aftermath when they happen. So these two systems, they have really clear, distinct roles. OSHA's entire mission is proactive. I mean, it exists to prevent injuries from ever happening by setting and enforcing safety standards. Workers' comp, on the other hand, is reactive. It's the state-mandated insurance that kicks in to provide financial support after an employee gets hurt. It's really the difference between prevention and compensation. And even though these are totally separate systems, they have what you might call a symbiotic relationship. See, an OSHA citation isn't going to magically change your insurance policy overnight. But what it does do is send up a massive red flag to your insurance carrier. That citation becomes a public record, basically screaming that your workplace is high risk. And for an insurer, well, risk is everything. So, how does this all really play out with your money in the long run? Let's get past the initial sting of a fine and look at the ripple effect that can seriously impact your business for years. This quote from the Wallace, Cooper, and Elliott Insurance Agency just nails it. This connection is fundamentally financial. The impact of a safety violation is not a one-and-done event. It's a lingering cost. This right here, this is that hidden drain on your business we were talking about. It all boils down to this really critical number called the Experience Modification Rate, or EMR. The easiest way to think about it is as a safety credit score for your business. An EMR of 1.0 means you're average for your industry. If you have a great safety record, your EMR dips below 1.0 and boom, you get a discount. But a worse record pushes you above 1.0 and you're paying a surcharge. And here's the key. Insurers use your EMR to predict your future, not just to judge your past. It's a direct chain reaction, really. It all starts with an OSHA violation, which, remember, becomes public record. Insurers see this and immediately flag your company as a higher risk. This, plus any actual claims, drives up your EMR. And the result? Your workers' comp premiums go up, not just for 1 year, but often for 3 years or even more, because that bad history gets baked right into your rate. And believe it or not, in some states, the connection is even more direct and painful. Take Ohio, for example. If you accept an OSHA citation that's related to an injury, the workers' comp payout for that specific claim can be legally increased by anywhere from 15 to 50%. And in other states, that penalty can go as high as 100%. I mean, that's just a massive financial hit. Okay, so that's the problem, right? It's pretty clear that non-compliance is incredibly expensive. So let's flip the script and start talking about the solution. And it all begins with building a rock-solid foundation of safety with a clear compliance checklist. Now, before we get into any specific rules, you have to know about the General Duty Clause. It's really the cornerstone of the entire OSHA Act. What it means is that even if there's no specific written rule for a hazard, employers have a fundamental responsibility to find and fix recognized dangers. Think of something like a frayed electrical cord in a busy walkway or boxes stacked so high they're about to topple over. It's the ultimate catch-all for workplace safety. And here's a look at what that means in practice, right from an official OSHA publication. Now, there's a lot here, I know, but some of the absolute non-negotiables include things like providing safety training in a language workers can actually understand, supplying all the protective equipment at no cost, keeping accurate injury records, and posting any citations publicly. These aren't just suggestions, they are the law. So, where do you even start? Well, if you want to know where to focus your efforts first, just look at the data. Year after year, inspectors find the same problems over and over in just a few key areas: fall protection, hazard communication, and scaffolding. Seriously, mastering these basics is the fastest way to improve your safety record and slash your risk. A simple audit of your fall protection gear and ladder safety could be the highest impact thing you do all quarter. Okay, so you're working on compliance, which is great, but what happens if an OSHA compliance officer actually shows up at your door? Let's pull back the curtain on the inspection process so you know exactly what to expect. First off, these inspections are rarely random. They are almost always triggered by something specific, and they usually happen without any warning. The number one priority is a report of imminent danger, but they're also prompted by things like fatalities, worker complaints, referrals from other agencies, or even just a follow-up to a previous inspection. So what happens after the inspector leaves? Well, OSHA has up to 6 months to issue any citations. Once you get them, the clock starts ticking for you to fix the problems. But here's a crucial tip a lot of employers miss. You have the right to request an informal conference. This is your chance to actually discuss the findings and potentially negotiate the penalties. It's a huge opportunity. And it's so important to remember that throughout this entire process, your workers have protected rights. They can file a complaint confidentially, they can speak privately with an inspector, and any form of retaliation against a worker for exercising their safety rights is absolutely illegal and brings its own set of severe consequences. All right, let's bring this all together. It's time to stop thinking about safety as just another mandated expense and start seeing it for what it really is: a smart, strategic, and profitable business investment. I mean, just look at the sheer difference in scale here. In a sample year, all the OSHA penalties nationwide added up to less than $150 million. But in that same year, workers' comp costs were nearly $72 billion. The fine you might pay? That's just a drop in the bucket. The real financial damage comes from claims and those skyrocketing insurance premiums. Even OSHA says it themselves in their own handbook. A safe business is a sound business. The investment you make in safety today is what literally protects you from those much, much larger and often devastating losses down the road. When it comes right down to it, proactive safety is about controlling your own financial destiny. Fewer claims means a better EMR. A better EMR builds trust with your insurers, which leads to lower premiums. And that puts real, measurable savings back into your business year after year after year. Which really brings us back to the big question for your own business. Is your safety program just another line item, an expense to be minimized? Or is it what it truly can be? The single best investment you can make in your people, in your reputation, and ultimately in your bottom line.